Welcome, everybody, to this presentation on everything you need to know about tax-free savings accounts and more. And let me tell you, there are things I'm sure that you didn't know, and probably not your friends either, because as we go through the program of having the tax-free savings, there's things that even I'm learning. And when I learn, I want to pass this information on. So Dan and I are doing this presentation to help you know everything you need to know. If there's something that we've missed, you can always give us a comment or go to our website and contact us and let us know. So we hope that this presentation helps you. So thank you for attending. So the agenda tonight is going to be what's a tax-free savings account, what it is, eligible investments that you can actually put in your tax-free savings, and if you have any questions and answers. Since I'm doing this recording, you won't be able to ask questions because you're going to be watching it after the fact. So what a tax-free savings is? Well, it's a gift from the Canadian government allowing us to shelter money for life. So when you open up a tax-free savings account, you have a place to accumulate money. You could use this for emergencies, education, maybe supplement your retirement income, purchase a home if you're younger and in that market. And it's also great for estate planning because it gets to reduce estate costs. So there's no probate as long as you have a beneficiary or a successor holder. Now, this plan was started in 2009. In other countries, they had something similar to this for quite a while. But the fact is now we've been well into this plan, and it's a fantastic, fantastic present that our government gives us year after year because they haven't taken it away. I mean, with any government, you don't know what they're going to do when they're put in office. So for now, enjoy it while you can and take advantage while you can. So some of the things you have to be aware of, you have to be at least 18 years or older to open up the plan. And that's as of 2009. So if you were born later, that you were not 18 by 2009, you might have to wait to open up your plan till, I'll say 2010, 12, 15, whatever it is, but you must be 18 when you open up your plan. And the contribution room will be from that year that you're 18 onwards. You must also be a resident of Canada. Now, the annual contribution is $6,500 as of January 1st, 2023. So currently, if you haven't done it, and we're already close to the end of the year, you can put in $6,000 for 2022. But if you've not opened one up at all, your maximum room before the end of 2022, if you were 18 in 2009, would be $81,500. If you take out money and you had, I'll say, some growth, your room might be more than $81,500, but that's just a contribution room. And we're going to talk about what happens when you take money out as well. But starting January, because of the extra $6,500, you will have room to put in $88,000. Now, the contribution room accumulates whether you're working or not. So unlike the RSP, where you have to have earned income and you're allowed to put in a percentage up to a maximum, with the tax-free, if the government gives us, and again, I'll go with January 1st, 2023, $6,500 room, then that room, if you can't put it in, will continue to accumulate year after year after year. So if you turn 18 in January or sometime in 2023, that would be the only room you would have. And it will continue because a lot of 18-year-olds will not have $6,500 to put in. But you can get this when you win a lottery, get an inheritance, start working. You can at that point start to catch up. When you put money in a tax-free savings, the contributions are not tax deductible. But you are also allowed to take money out at any point out of the plan, and you don't have to worry about paying taxes on that money. Not on the growth, not on the income, and not on the capital that you put in. And then if you do take money out 1 year, you can put back anything, your contributions and any income or growth that it made, you can recontribute in the following tax year. So say, for example, you took money out in December, but you knew you were getting a bonus at work in the new year, you can put all that money back in the new year. So it doesn't have to be 12 months. It only has to be in the tax year. So 2022, you take money out, you can put money back 2023. Now, you don't have to if you want to put it in 2024, 2025, or never, it doesn't matter. But you have the option if you want it. So the tax-free savings is not like a checking account where you use it in and out. Where it would be more like your long-term savings. So you would use that maybe for an emergency fund or just something, as we talked about, you know, to save for a house, maybe supplement your retirement income. You can make contributions to your tax-free savings right up until the end of the year in the year that you pass away, which means if you're dead, your spouse can actually make a contribution. And you're probably thinking, well, why would they want to do that at that point? What happens at that point is that if you have a spouse when you die, the spouse will get the money from your plan, whether they've maxed out their own plan, which means now they've doubled up their room and they've doubled up that room for life. So again, for 2022, we're almost at the end of the year. The contributions are $6,000. They've been $6,000 for a few years. We did have a year where it was $10,000, and before that it was $5,500, and before that it was $5,000. If you're going to max out, you can go to the CRA website and you can find out what your room is. If you've never opened up a plan, it's pretty easy to calculate if you were 18 at least on 2009, because we can just tell you the total. And if you Google, you can just find that out as well. So the accumulation room will carry forward indefinitely. And the contributions are made in after-tax dollars. If you were working and using employment dollars, you would have paid tax on that money. But once it's in there, it can grow for the next 30, 40 years, and it can make a lot of money for you, and then you'll never pay taxes on that money. So again, to reiterate, withdrawals are tax-free. The name is a tax-free savings account, and it's named that for a reason. It's tax-free forever. The money you put in might have been taxed, but that's the only time you will have paid money, taxes on that money, because once it's in the tax-free, it's tax-free for the rest of its life. It grows tax-free indefinitely, so you don't have to wind it up at a certain age or a certain date, or that there's a limit to how much you can put in and then it stops. You have no time limit to collapse it until the date of death, because that year it will get collapsed. As long as you have a beneficiary or a successor holder, it will get moved over or paid out to beneficiaries. Well, daily interest could be what you have. GICs would be another one. But anything that you invest in your RSP, you can pretty well invest in the tax-free. That means if you want to buy stocks, bonds, mutual funds, exchange-traded funds, any kind of savings in GICs, a mixture of any of those combination, you've got the opportunity to do all of that. It is, again, a gift from our government that you should take advantage of. Imagine if you had bought a particular stock, just say you bought Tesla a number of years ago, and that stock went through the roof. You know, you might have $200,000, $300,000 now in your tax-free savings. You need money to buy, I'll say a new car, put a down payment on a house, whatever. You can take all that money out and it doesn't matter how much money you're making. It will not affect your taxes. Now, having said that, say you bought a stock and you bought a stock that actually lost value or actually went down to zero. Your investment losses are not tax deductible. That's because you never have to claim the upside. You cannot claim the downside. So if you're going to be investing in your tax-free saving, just say an individual security, and it's a high-risk security, you may want to rethink that, because outweigh the percentage of going up versus going down. If there's a good percentage, you could lose money on that stock. You're better to put it in your non-registered account where you can write off those losses against future gains, or even go back if you had some gains that you paid taxes on. But remember, that's where you want to talk to an advisor, because you want to make sure that when you're buying stuff for the tax-free, potentially you're going to see mostly upside. And yes, I know we're in a period where markets are volatile right now, and mutual funds might have gone down, your stock might have gone down, your exchange traded fund might have gone down, but we know the potential to go back up is around the corner. And so that's not what I'm talking about. I'm talking where it probably is going to end up being a permanent loss. You don't want to take chances on those type of investments unless you think the upside is so great that you would rather know that you're not going to pay taxes on the gain that you would make on that particular stock. But again, always advisable, talk to your financial advisor. So the gains or income, so income could be from dividends, it could be interest, whatever it is, nothing is taxable inside the tax-free savings. The good thing is, if you're on right now, because you're 65 or older and you're collecting old age security, and you know that your total income could be affecting your old age security, and you need money, just say put a new roof on or take a trip around the world or whatever you want to do, you can take money out of your tax-free savings, and it doesn't matter how much you take out, it won't affect any other government plans. Definitely, it won't affect your old age security. And if you get GIS, it won't affect that as well. Again, it's a gift from our government. So you could also transfer the proceeds upon the death of a spouse to the tax-free of their other spouse, regardless of whether or not they've maximized their plan. This is where, if you don't have your tax-free savings, I'm going to say with us, with Dan and I, because we always make sure that everything is set up properly, but say you have it with another brokerage, or say you have it at the bank, you want to make sure, if you're in a common law relationship or a married person, that you have what's called a successor holder. It's like a beneficiary, but the difference is it can roll over on the death of one spouse to the other, and you've doubled up your tax-free savings room for life. This is a biggie. That means you get to shelter even more money than the average person. Now, if you've got it set up as a beneficiary, not a successor holder, your spouse will still get the money tax-free, but they don't get your room that you've just, lost because you're dying. Anyway, and all of this bypasses probate. So you always want to have a beneficiary or a successor holder on your plan, at least for estate planning purposes, to make sure that you bypass probate. Now, what happens to your tax-free savings upon a marital breakdown? Hey, they say that it's a 50-50 chance that your marriage is either going to survive or it's not. And in second and third marriages or relationships, the percentages are even higher. But when you've accumulated money during your marriage or your common law situation, that's matrimonial assets. And it could be that some of those assets will actually have to be paid out to the other partner. So if you do a direct transfer on a marital breakdown, you can increase the room for that recipient. If you transfer the proceeds to your spouse, your spouse is the recipient, they now have double the room, but you lose the room. Now, again, because it's a gift from our government, you can't get back that room. If you've transferred your money directly from your tax-free to your spouse's tax-free on a marital breakdown, you've lost the room forever, and they've gained your room forever. So if you're in a situation where you're going through and having to use the proceeds from the tax-free savings, do not transfer it, regardless of whether your lawyer or your spouse wants it that way. You say, my tax-free happens to be worth $125,000. I will cash it out and give you the money. That way, your spouse still gets the money, but now in the following tax year, you get your room all the way back, which means if you gave out the 125 in the next calendar year, you get to put 125,000 back if you have the money, or it carries forward for a future time when you do have the money. So remember, no transferring. Now, if you're the recipient, you're going to try to get your spouse to transfer the money over, because if they don't know that rule, it makes it better for you as the recipient to double up your room. So depends on if you're the receiving or, the giving side. Again, talk to your financial advisor when you're going through a marital breakdown and when you know assets are going to have to be split. What happens when you overcontribute to a tax-free savings? Our government, as kind and generous as they are to give us this plan, will also be extremely penalizing if you overcontribute your limit. And that penalty is 1% a month. So say you've overcontributed because, like some people, you can have more than one plan, but you can only have the limit that the government sets out. So say you did early in the year, you made a contribution at the bank in a tax-free because they convinced you, oh, you got to do that. You got all this money in your savings account. Open up this savings account. This will be good because, there's no taxes on it. You're not quite understanding it's a tax-free that they've opened. You put the money there and you deal with a brokerage. Just say somebody like me and Dan, and we have a tax-free open for you. And we're saying, well, listen, you've got this room for this year. Let's put this money in. And you say, oh, yeah, sure. And either give us a check or we take it from your bank account, or, you have a non-registered with us and we move that money over to your tax-free. And all of a sudden now you get a bill in the mail, 1%. So if that was $6,000 that you overcontributed at the bank and with us, all of a sudden that's $60 a month until you get it out. $60 a month. That's your hard-earned taxable money that you have to make to give to the government because you overfunded your tax-free savings. It's why Dan and I always try to get people to have one plan, regardless of where it is. Now, obviously, we want it with us, but the fact is, if you want it somewhere else, that's fine, but it's easier to make sure you don't overcontribute. You don't want to be giving the government extra money back. And for most people, it's a hardship to have to pay more in penalties and or any kind of taxes to the government, because a lot of people are living pay to pay and it's hard enough to save the money and then all of a sudden have to pay these penalties. So try to keep yourself down to one tax-free saving. What happens to your tax-free when you leave the country? Well, as long as you were living and a resident of Canada, you can keep your plan, but you can't add to it. So if you moved away, given up your residency, and you're now resident of another country, you can't add any more money to your plan. but your plan will continue to be in existence and it will continue to be non-taxable to the Canadian government. And of course, you will, if you make contributions to your own plan, say it's your one and only plan, but you are resident of another country, same idea though, that will be considered an over-contribution and your penalties will be 1% a month until it's removed. Also, any money that your plan makes while it's in Canada, your new country of residence could tax you on that. So it's possible we're not taxing you, but it is possible that there could be taxes to pay from another country. So now, can dual citizens have a tax-free savings? And this happens a lot, especially because we have a lot of Americans living in Canada. And they sometimes want to have the tax-free savings. In actual fact, Dan and I had a client. He was American living in Canada and he had one. He wanted it. He knew the consequence of having it. And there was, I'll say, extra complicated taxes reporting that he had to do, but he felt it was still worth doing it. So he kept it up in Canada. We don't really recommend this as a good idea when you're a dual citizen. It can cost you money. And in a lot of cases, those taxes that you make, that income that you make here in Canada will be taxed in another country anyway. I personally don't see a really big benefit, but it's possible. It's just not advisable. Again, talk to your financial advisor. This is one thing that a lot of people don't know. They all think that the tax-free savings, because it's in Canada, must be in Canadian currency. And it doesn't. You can actually have a US currency tax-free savings. And what they'll do is they'll do the equivalent. So just say you're putting in your $6,000. Now you want to put $6,000. You can't put 6,000 American US dollars because it might only be worth 4,000 American if you did the exchange. So it would be 4,000 US dollars going into your tax-free savings. But why I like it and why a lot of people may find it beneficial to have a US tax-free savings is because if they travel a lot to the States and they need US currency, they don't have to worry about always wondering about whether or not the exchange is in their favor right now. So I personally have a tax-free savings in US currency. I have both Canadian and US, and it works well for me because as I get dividends and stuff in my tax-free savings, I get to take it out when I'm going to the States. And the good news is the following year, I get to put money back. So it works for me and it may work for you. So again, talk to your financial advisor and see if this is something that would be beneficial to open up for yourself. So why open a tax-free? Again, I'm telling you, and Dan and I talk about this all the time, my partner, about how beneficial it will be, especially down the road. And I know when it first opened up, people said, oh, what's putting $5,000 away? Big deal, sheltering that. Well, now, as of January 1st, 2023, you can shelter $88,000 of money that you may have that you're getting either dividends or growth or interest on, that you're actually having to claim that on your income tax. And if you're still working, that's a lot of extra money you're paying the government for nothing. So if you can, and between a couple, that's a lot of money. I mean, we're almost pushing 100,000 each. And not only that, you got to remember, whatever it's making. So a lot of tax-free savings, when people have maximized, they're already well over $100,000. That's a lot of money to shelter that you never have to pay taxes on. So you want to sit down with your trusted financial advisor. And if you don't have one, give Dan or I a call. Our website, Levesque Wealth Planning, we have our calendar on there. There's all kinds of ways to contact us. We can sit down. It doesn't cost any money to sit down and find out more about whether or not that would fit into your financial planning. But the best way is to get started is to stop talking about, I'm going to do it, I'm going to do it, I'm going to do it, If Walt Disney had done that, he would never have created Disneyland or Disney World. He had a vision, but he didn't just talk about it. He actually sat down with somebody and got it created. You know, it's like Dan and I have a lot of clients a lot of times saying they're going to do their will. They're going to do their will. And before you know it, their minor kids are now adults. Now, the good news is their adult kids can be the executors or the estate trustee, as it's called in Ontario. But the whole thing is that you got to do something at some point and make it happen. And the tax-free is something you want to make happen. So Dan and I do all kinds. When you think of money, you can think of us. We're like money doctors. You can give us a call. We've had a lot of experience between the two of us, and we would love to help you. Now, this is our team, and we also have a couple of other people, specialists that we deal with, but these are the people you would be dealing with on a regular basis if you were to contact us. And of course, our disclaimer is to let you know that Dan and I created this this information on tax-free savings. We do our best due diligence to make sure it's accurate, but our company just wants to make sure it's not them, it's us. So all of this is, you know, I'll say almost like our opinions, and it's our representation of tax-free savings. But we're glad you could join us. We're glad that you could stay for the full presentation. And if you need any more information, reach out to us, or of course you can contact if you have another advisor. But make sure you get the information you need to do a proper plan. So I'm Linda Levesque. My partner Dan is not on the presentation with me for the introduction, but we thank you and we look forward to serving you in the future if you decide to become a client. Thank you.